Hey guys, it's Tanner Manson from Future Investing, and today I want to talk to you guys about the top 3 picks from ARK Invest Holdings. In my opinion, I think that these 3 stocks are going to be the highest growth stocks from their picks that I think will, also have the least amount of risk going forward. Obviously, there are some very small companies on ARK Invest Holdings that I think could obviously jump up a ton, but the chance of that happening is slim, and for these 3 picks, I want to make sure that these are great all-around companies rather than speculative picks. But just before we get into it, I want to say, although I am actually a licensed financial security advisor as my full-time job, none of these stocks or topics that we talk about today are in any way my recommendation. This is merely my opinion, and you can choose to do what you wish with this information. Now, before we get started, if you could, hit the like button down below and subscribe if you want to see more content like this. I put out a lot of content mainly on Tuesdays and Fridays, and I follow ARK pretty closely. Anyways, let's jump right into this with stock number 1, which is going to be Shopify. Ticker symbol SHOP. Everyone knows this e-commerce giant. They're a huge competitor to Amazon. They help businesses of all sizes get online and help start selling their products or services directly on their own domains and their own websites. From distribution models to payment processing models, they do everything in between, including dashboards and analytics to help, businesses understand who their customer is and how to better serve them. Now, to quickly break down some of the financials of the company, currently at the time of recording this video, the current share price of Shopify is $1,182 with a 52-week high of $1,500 a share. Currently, that makes up a market capitalization of $147 billion. And fun fact, it's also the biggest company in Canada. Right now, currently, they hold about $7.9 billion in cash with only about $1 billion in debt. Very, very cash heavy. And after we just saw the first quarter results for 2021, which we will go into, that makes out a price to earnings ratio of 92 times for this massive tech giant. Now, the reason why I put this on this list is because Cathie Wood is buying it like crazy. Currently, they have fallen a lot from their 52-week high, and Cathie Wood loves buying the dip. Now, she can say anything about all the stocks that she's holding and the price targets she puts out. I do not put any emphasis towards any of those. You can't trust what Cathie Wood says, but what you can trust is what she's buying. People vote with their dollars. For example, hedge funds pump and dump all the time. They'll say things are better than they are. Once the price rises, they sell out and get out quickly before it even hits their price target. So I have that same sort of fear with Cathie Wood, but whenever she's buying and not addressing those trades, it's because she's trying to put up a huge position before announcing that sort of trade. But because it's an ETF and not some, private hedge fund, that we can see her trades on a day-to-day basis. It doesn't quite give us the upper hand on hedge funds. Obviously, they'll be buying first, but what it does allow is for us to see, let's judge her based on, rather than what she's saying on, newscasts and whatever, and see what she's actually buying with her dollars and allow us to make our decision based on the amount of shares that she owns in a particular stock. That, in my opinion, is way less biased and gets you a fuller picture of what she's actually holding and what she believes in. Now, I'm not going to go too much in depth about what the company's actually doing. I'll do a little summary of Q1, but if you want to see a fuller picture of what Shopify's been up to, you can check out my video right here. Now, they did say in Q1 that they've been holding up a 45% compounded annual growth rate since 2016. That is mind-blowing. It's faster than Facebook. If you know anything about this stock, you know that, the actual company and the stock price has been growing over 100% year over year since it's been public. That is practically unheard of, except for a couple, maybe, outstanding companies that have lied on the stock market. And people aren't crazy for investing in the stock the way they have. If you look at Q1 of 2021, revenue grew year over year of 110%. Their subscription revenue year over year grew about 71%. And this is primarily due to new merchants coming to the platform. So there's consistent growth. And then in terms of merchant revenue, you have 137% growth year over year. And this is mainly because the people that are going to Shopify are selling more than they ever have. Add those two things up. You have the actual merchants that are coming to the platform growing by 71%. And then 130% is growing of how much gross merchandise volume is selling on their platform. Those two things combined, having, more people selling more and also having more people coming to your platform is an absolute dynamite solution for success. And that's why the stock price really doesn't have that many corrections long term. This stock just continues to go one way and it's up. And I don't see that changing anytime soon for Shopify because the numbers and the growth and the ways that they want to grow are only expanding. They're taking a very similar approach to Amazon where, the things that they want to do with this company are only getting wider and wider. So why would it ever slow down? Anyway, that's my piece on Shopify. If you want to see more information about it, you can check out my link in the description down down below. And now going on to stock number 2, we're going to be talking about Teledoc. Ticker symbol TDOC. Teledoc is a web service and app that allows you to talk to US doctors, or depending on what country you are, but Teledoc is very, very based out of the United States currently. And this will allow you to get your telehealth solution. So for example, they'll be able to diagnose you for non-emergency matters over the phone or directly on video calls. These meetings, by the way, are called visits. Now, currently, as of recording this video, the current share price for Teledoc is $172 a share. And now this is very important. Their 52-week high was $308 just back in February. This means that Teledoc is now down 44% from their all-time high, which making up a market cap about $26 billion. Now, this is definitely not my favorite part, but their cash is $723 million with debt of around $1.4 billion. Now, you're probably guessing already that because of those, that their PE ratio is already non-existent. This company currently is not profitable. They've never been profitable. But if they keep up the way that they're growing and get their costs down, they will be, or could be, in a very short time. Now, I'd also like to bring up that who owns this stock, which, held by institutions, is about 79% of this stock overall, which out of the 3 that we're going to be talking about today is by far the highest. Now, obviously, it's important to know why Teledoc has dropped so much since their all-time highs, aside from, the sort of tech sector crashing back in like early March of this year. So first off, they missed their Q1 earnings per share by 69 cents. But worse than that, I think mainly the stock is dropping because of their visits. And although they're expecting the numbers to grow on their visits, they're only expecting this year's growth to be about 23%, where last year was 156%. It is a stark difference from what they were expecting or what investors thought, the growth that could keep up with. And obviously, as you guys probably know, if investors, differ on their opinions of what they think is acceptable versus what the stock or company is doing, that, investors vote with their dollars. And right now you're seeing a huge pullback so people can get into, higher growth companies or possibly invest in different things. Now, this is where Cathie Wood really, really does well. And I'm going to include myself here, but obviously I'm no Cathie Wood. But what I find happens is that the stock market over-exaggerates in both directions. Whenever things are really, really good, they go crazy and they invest and bring the stock way too high. And whenever things are slightly bad, they over-exaggerate and drop the price way too much. Most companies, most times, are right in the middle, Most companies perform well, but also don't completely die off. And I think Teledoc is in that state where people think that, this stock is done. There's a 44% drop back, when really, I think Cathie Wood also sees that, this stock is going places. Telehealth is the new sort of digitization, and it's going to be the next big thing. Not everyone's going to be driving around and wanting to do all the things that they did before, especially for something as boring as sitting in line to wait for your doctor at a doctor's office. So this business allows you to stay at home, wait by your phone, and whenever it buzzes, you have your meeting. And it's so much easier, especially for whenever you just have a cold, or maybe your tonsils are swollen, or something that's not so emergency based. And now a lot of people love talking about the stocks that they hold because Cathie Wood holds them. But I'm sure, unless you're talking about Tesla, that Cathie Wood does not hold as much stock into it like she does with Teledoc. This is Cathie Wood's second biggest holding, and she's holding about 9.5% of the overall entire company. So, considering how small this company is versus how big of an actual position that she has, she is in love with this company. Percentage-wise, she owns a way bigger position in Teledoc than she ever has in Tesla. And knowing that she has 9.5% ownership in this entire company, it's fair to say that she has a very close relationship with the owners. She knows exactly what's going on and what their plans of growth are, regardless of what they're telling to the markets or to public newsletters or whatever. During this dip, she's continued to buy Teledoc at every step she can and not sell any shares. Honestly, reading up about this company was maybe the most excited I've ever been about a company. And it's probably why Cathie Wood's so excited about it too, is that they're just the amount of opportunities that they have going forward is insane, especially with this new acquisition of Livongo. They're cornering a market and absolutely have a massive moat around not only telehealth, but also diabetic patients. And the sort of data sets that they get from all this will lead to massive, massive money in the future. And I think in the short term, this company will become profitable. Don't hold me to it. This is not financial advice, but it's just my opinion. Anyway, on to stock number 3, we have C Limited, ticker symbol SE. Now, I hesitated for a bit to put C Limited with, Teledoc and Shopify, but I still think it deserves to be here. Regardless, that I do have to say, ARK has been selling shares within the recent history. They're trimming positions. It's not quite good to see that, but I do still want to tell you guys about the stock and, make an opinion for yourself. There may be some things I don't know about this company. Obviously, Kathy Wood's research teams are way better than mine. I mean, I've got no team. It's just me whenever I have some free time. Anyway, I'll break down some of the financials for you and, hopefully tell you a little bit about the stock and you can make your opinions for yourself. Currently, this stock at the time of recording this video is at $252 a share with a 52-week high of $285. Definitely not as big of a spread as Teledoc, but still there is some room to grow. Currently, the share price makes up for a market cap of $131 billion, which in Singapore makes this the biggest company that they have. And if it's anything like all the other companies that ARK owns, it's obviously not profitable. I mean, aside from Tesla in recent history, but this is a growth company. And it's always funny, same thing with Shopify, to see these companies beating out, their biggest banks and all these things. But anyway, let's continue. Right now, they have $9.3 billion in cash with only $2 billion in debt. Love to see it. I already said that they're not profitable, so obviously their price to earnings ratio is non-existent. Yet what I always like to see is that held by institutions are up 74%. A lot of the times, the reason why I bring this up, some people ask why I like this statistic so much, and it's not that I really like it, but it's still cool in my opinion. Most times, institutional investors on a quarter-to-quarter basis have to post their earnings. So they don't want to pick, risky stocks because it might hurt them in the short term. Seeing institutional investors be so bullish for growth companies helps me see that, these stocks might be more conservative than I'd like to think. I don't have research teams, so a lot of the times, it doesn't hurt to sort of look at other people and go, what are you guys doing? And I love that, and I love seeing, a little bit of confirmation bias. The same reason why you guys are watching my video right now is to know that someone thinks the same way that you do. So I'm a big fan that 74% of them are institutional investors. Now, to break down C Limited, it's quite confusing. They are a massive ecosystem that breaks down into 3 different segments. First segment is Garena. This is a gaming platform very, very similar to Steam, where it allows gamers specifically in Southeast Asia and Taiwan to be able to game, different sorts of games. And what's also funny enough is that Tencent is the biggest holder of this company. They're the biggest major shareholder, and all of their games are on Garena. And the most exciting part to this segment, maybe some of you guys already know, but they have the most popular mobile gaming app called Free Fire. C's quarterly active users hit 610 million users at the end of Q4 of 2020, which was up 72% year over year. Now, the best part is that their quarterly paying users is up to 73.1 million, which is up year over year 120%. So I always say this, but not only are we growing the company like at an insane rate, but also the amount of people that want to pay for the business are growing even faster. So more people are joining, and then more people within those people want to actually pay for the service. That is a key to success. Now, that's just one segment of the business. Now, the next sort of ecosystem that they have, which is by far my favorite, which is Shopee. Shopee is the top ranked downloaded app in the shopping category for Southeast Asia and Taiwan. Now, I'm not going to explain too much about what Shopee does. I mean, it's a regular shopping app. It's just a matter of how popular it really is. But I can explain that pretty easily with gross orders catapulting 135% year over year from Q4 of 2020. But yet gross merchandise value year over year has gone up 113% to $11.9 billion. But now segment 2 and segment 3 kind of tie in, so I'm going to bring it up now and then sort of loop back. So segment number 3 is C Money. This is their digital financial service app that is really picking up traction. In the year 2020 alone, they had total payment volumes of $7.8 billion, with 23.2 million quarterly paying users at the end of Q4 of 2020. But now the best thing about this stock is that, having all these ecosystems in different spots is that they're able to cross-sell very easily. So I'll give you the best example I can give is that, for example, Shopee, 30% of the orders that are sold through Shopee are paid for by C Money wallets. Whether they're doing that through incentives or whatever, I'm sure they are, because the company is a little not profitable, like I said, and the net losses keep going higher and higher. But the amount of customer acquisition that they're doing, that they're just spreading like crazy, which is the same Facebook model that they did, which is, they wanted to keep the business cool and focus on growing the business. And like I said, and I'm not going to go too much in detail because I have my own standalone C Limited video, but Tencent is their major shareholder. So if anyone's going to tell them how to sort of grow in this business, for a business that they've been in, that they have almost this big brother who's a major shareholder, so they want them to succeed, sort of guiding the path of how they're going to grow this business. And what they're telling them to do right now is give big incentives and get the acquisitions high, and it's happening. It's happening like crazy. As more people use C Money and Shopee and everything, not only are the customers going to go up, but the actual gross merchandise volume is going to go up as well, which obviously leads to more revenue back to C Limited and hence goes back to the shareholders. I personally think it's a great strategy, but obviously staying at that net loss, and not only, but having larger and larger net losses each year is very hard to stomach as an investor. But anyway, tell me what you guys think about my 3 picks. Is there one that I'm missing? Maybe there's some Tesla bulls, obviously. If you're watching Cathie Wood and ARK Invest, that Tesla's obviously going to be on your mind, but you might have seen my videos in the past how I feel about Tesla. It's a car company, but regardless, I still love to hear your opinions on the video. Are there any of them that you really haven't paid attention to out of my list that you might start, adding to your watch list and start following yourselves? Like I said, although I am a financial advisor, this is not financial advice. So do your own research, do your own due diligence, and make sure that if you are going to make a purchase of any stock, that you know what you're buying into. But anyway, if you guys like the video, please give it a thumbs up and subscribe down below if you want to see more content like this. I've got, a bunch more scripts that I'm trying to put out and, new content, multiple times a week, but it is hard. I still have the full-time job and I'm still trying to, have a good or decent work-life balance, but I'm trying to put these videos out for you guys. Hope you guys are enjoying it. I know I've got a couple regulars that I'm talking with in the comments. I'd always appreciate if you guys say hello. I always respond back to all my comments that I get. Anyway, thanks for watching. Stay safe trading. And until next time, guys, see ya.